I mean, after Cloudflare said they're absolutely dead, but they're making a comeback. Good for them. And these are companies that provide security to your content delivery network. Cloudflare, a symbol NET, is my favorite by far. That's Matthew Prince. He's done a remarkable job in trying to get it so that you can't crawl through, you can't scrape. He's trying to preserve the journalists, even us. Preserve even us.
Trying.
Well, CNBC, we got a body of work here.
Right, so they block the ability of AI.
We don't want Perplexity, which might be bought by Apple. That's me telling you that. There's no evidence whatsoever that Apple is even interested in them. But Perplexity scrapes. Matthew Prince told me that Perplexity is the worst actor of all.
Why? What do?
They scrape it around. They scrape. They take your stuff. They make it so that you don't keep your value, David.
Well, the president said you can't enforce copyright like we used to. It's just, in his words, the Chinese don't do it.
Well, okay.
Yeah. It's just a new era of technology and curation.
If you're old, man, it's hard to be a media company. You're getting scraped. You're not getting paid. SEO is gone, by the way. Search engine optimization. That's not happening anymore because people are using AI. They're getting full answers. They're not clicking on links that takes them to the original source.
And they're able to summarize very quickly what you say, but not give you any attribution. Not as if, almost as if you're a student and you're plagiarizing. That's what a lot of people feel is plagiarism.
Yeah, and we'll see what's to come. I mean, guys, it's funny. On media, Warner Music Group, I think they let go about 13% of their overall employee base. They reported earnings and margins went up.
Well, if they fire everybody, I think you go to 40.
Exactly. But this is, that wasn't even AI. That was just, all right, we got too many people. We got to reduce, we've got to ultimately reduce. But the point is, what is AI going to bring in terms of, again, the losses of jobs, increase in margins? You're going to have a bunch of corporations making a lot of money and nobody's going to be working for them.
What does that have to do with the price of Dutch Bro?
I don't know.
Dutch Bro.
Well, it has to do with
fewer working people getting coffee.
Exactly. People got to be able to afford to get coffee.
I can get the AI's not making the annihilator. He's not yet.
Yeah, I know, but if nobody's working, nobody's drinking coffee. Well, maybe a little bit.
Maybe they're having a darn good time.
Look at Dutch Bros.
No, that's what I just mentioned.
I'm aware. I didn't know it was up 20%.
Dutch Bro. You don't pronounce the S. Dutch Bro. You know, like, hey, bro?
I like bros.
Hey.
You're my bros.
Hey, bro, taser you know?
As we go to break, take a look at bonds today. That 10-year note auction yesterday was received as being somewhat weak. We'll get a 30-year today at 1 o'clock. Productivity, though, was pretty strong, 2.4. We were looking for 2. And then jobless claims, 226, although continuing claims once again hit a new cycle high. Stay with us.
Director, Equity Research, Wedbush Security, was shining about DoorDash. It's up 3.5% here at the open.
Well, everything was good. Orders accelerated, gross order value accelerated, revenue accelerated, margins are expanding. So it's the leading market share player, in the U.S. Doing extremely well, kind of clicking on all cylinders. So the fundamentals are outstanding. I mean, the only constraint would be the stock's up about 60%, year to date. But from a business standpoint, I don't think it could be doing any better.
So when we see this stock at 266, you recently raised your price target. Was that a valuation call? Or you still think there's room to run here from 266 to 280? What drives that?
Well, we're in a momentum market, so good news leads to higher prices in a bull market, and so I think DoorDash has momentum on its side. We have a neutral rating on the stock. I do think the valuation's elevated, but it's a phenomenal company that's priced for being a phenomenal company. So that's why the rating is where it is. But I do think the bias is more to the upside until there's a misstep here or there's a change in the macroeconomic backdrop.
When we think about DoorDash, I mean, what's DoorDash doing versus its competitors to see this rise and move to 52-week highs?
So, I mean, DoorDash has a density that others lack, for one, and so it gets you food more quickly. It has more options for delivery, which gives consumers a better selection, and it focuses 100% on this business versus its largest competitor, who's doing quite well in the category as well, Uber, but is managing two very different businesses at the same time. So I think that focus just allows DoorDash's business model to resonate a little bit more so with consumers.
I mean, Uber Eats, you just mentioned it. Which one is the real player? Which one's first place, second place, third place?
DoorDash is one. So in the US, DoorDash has 65% market share. Uber Eats is sub 30%, and DoorDash is growing faster, so gaining share. Having said that, Uber Eats is well positioned, but a lot of its success is happening outside the US, and so that business is doing quite well as well. It's just where DoorDash's business is more significant is in the US, and it really dominates this market.
Wasn't there a third one? Was it acquired? I'm having like a brain freeze. Wasn't there another one?
DoorDash acquired a company, Deliveroo, in Europe. There's been Grubhub, there's been others, but I mean, this is really, in the US market, it's effectively a two-player market now from a market share standpoint between DoorDash and Uber.
So you have a neutral rating on DoorDash and a 280 target. What about Uber or the Uber Eats part of it? Do you look at that? Do you throw some targets out there? Do you see it going higher?
So we look at Uber, in aggregate. We don't do a sum of the parts of the two different businesses, but our concern with Uber, I think the Uber Eats business is healthy, but I do think robotics, AI, autonomous vehicles are going to have an impact on the ride-sharing business over time. I mean, who knows? It could impact delivery at some point as well, but certainly not initially. And we're also neutral on Uber, and our concern more there is around the ride-sharing business and the possibility that it may not be as well positioned in the autonomous vehicle market as it suggests to investors, and that companies like Waymo and Tesla could prove to be disruptive to that business model as well as Lyft.
And you talked about the density. You can get your DoorDash fast. There's so many choices. What are people choosing when it comes to what to order from DoorDash? I mean, are we seeing clear leaders in the fast food space?
Oh, it's everything. I mean, the economy's relatively strong still. Unemployment levels are low. And so there's not specific categories, I think, that are standouts. I think it's a little bit of everything. In addition to that, DoorDash has more recently expanded into other areas, including grocery, which are showing some progress. And Instacart is the category leader there, but I would anticipate that DoorDash has some success in that category as well over time.
That's important. Grocery has been a bright spot across the board. Scott Devitt of Wedbush, thank you. Good to see you. Thanks for looking at DoorDash for us. Tom White is here, host of Fast Market. Taking a look, you have some example trades for us. Now, your first one here is a bearish example trade. Tell us more about that.
Yeah, we've seen that vol crush as the stock hit all-time highs. It's pulled back from those levels that we've seen, so fallen a little bit here. But that's not surprising. Overbought on a technical level at this point. But if you look at the IV percentile rank, it's down near the 20% level, so in the bottom 1/5 of implied volatility levels that we've seen over the last 52 weeks. So that gives you some opportunities in directionally biased trades, kind of trying to set up here with your guest outlook here. If you think it's going to continue to pull back, maybe some profit taking at this point, this strategy takes advantage of it, gives you a little bit of flexibility as far as trade management goes also. So I went out to the August 29th weekly options. It's 22 days to expiration. We're going to buy the slightly in the money 270 strike put. And then against that, because we want to offset some of those costs on that put, sell the 250 put. So $20 wide bearish put vertical, paying roughly about a $6.50, maybe $7 debit for this. but the debit you pay is going to be your risk on this trade. And if you pay $6.50 debit, it takes your break even down to $263.50 to the downside. That's only about 1.5% below the current share price. So you don't need a big monster move to get to that break even. And I mentioned that flexibility as far as trade management goes. If you do see that pullback, because you're buying a vertical like this, it allows you, if the price of it starts to expand ahead of expiration, it'll give you that opportunity to maybe close a portion or all of your position if it goes over a specific price level. But risk reward setup on this one, good. Break even's only about 1.5% below the current share price. If you're bearish on this name, go over the next 3 weeks, Nicole.
Yeah, and look, I mean, I was pulling up some of the food even to see. I mean, what an incredible chart for DoorDash. I understand why you have an example trade that's bearish, because this went from $121 up to $278, 1 year up 120%. Yeah. Well, nobody was watching. DoorDash was doubling. I mean, it was unbelievable to see it up 120%. And if you pull up some of the other names that people think are popular, like Chipotle, that in fact is down. Down 18% in 1 year, and then you scratch your head and say, what? I thought it was the best, and all these things. McDonald's is higher by about 15%, but that certainly doesn't compare to the 120% of DoorDash. Let's talk about your more neutral example trade that you have.
Yeah, same kind of setup as far as direction goes, but maybe a little bit more conservative than the bearish put vertical that I just talked about. This one, using that same August 29th weekly series, so 3 weeks to expiration on this one. Instead of buying a put vertical for a bearish stance, we're going to sell an out-of-the-money call vertical for a neutral to bearish stance on this one, and it gives you a little bit of cushion to the down or to the upside in case the stock does continue to move up. But going out to that same August 29th weekly cycle, 22 days to expiration, selling the 280 strike call, and then against it, we're going to buy the 290 strike call. So a short $10 wide neutral to bearish put call vertical. You're going to collect roughly about a $2 credit on that. That's what you can make, $200 per spread, but it takes your break even all the way up to 282 to the upside. That's about 6% above the current share price. So those are those trade-offs that we talk about. You don't have as much flexibility as far as trade management goes on this one. You just want the stock to stay below that 282 level into expiration over the next 3 weeks. The idea is this goes out worthless, but maybe it does contract in price. Maybe you close it ahead of expiration, maybe to get rid of all the risk. But you're risking about $800 to make only $200, but you've got a better probability of success on this type of trade because you have that 6% cushion to the upside.
All right, Tom White, great to see you. Thank you so much. Good luck there at DoorDash. Coming up next, Good Morning Trade, and we're going to preview Block. The earnings are due out this afternoon. It had the inclusion into the S&P 500, but Kathy Wood's ARC has dumped out. That's worth noting as well. More on XYZ when we'll be right back.
Trading at Schwab is now powered by Ameritrade. Wealth.
Good Thursday morning. Welcome to Walk in the Street. I'm Carl Quintanilla with Leslie Picker and David Faber. Live at push 9 of the New York Stock Exchange. Sarah Eisen has the morning off. Market enjoying a nice bounce here at the open. 63 85 as we look for sectors, almost all of them green. In fact, only healthcare is in the red, and we'll get to Lilly in a moment. Brett, very positive, almost 3-1 here at the NYSE. Coming up on today's show, Marcy Frost, the CEO of CalPERS, with us, which has more than $500 billion under management. She tells us where she's putting some money to work. Plus, the CEO of ConocoPhillips joins us fresh off earnings with a read on global energy demand. And then the president calling for the CEO of Intel to resign as he lays out big tariffs on chips with some exceptions. We'll get details straight ahead.
First, let's get some economic data that's just crossing. Rick Santelli has that for us. Rick.
Yes, David. We're looking at post-sale sales and inventories. On the sales side, this is a fresh June number. Expecting up a 10, comes in stronger than expected. Up 0.3. That's the biggest trade sales month over month change going back to March of this year when we were up 0.8. And the high water mark was February when we were up 2%, and we all know that's most likely anticipation, getting in front of some of the issues that ended up coming out from Liberation Day and the pull forward. On the inventory side, this is a final read, which means the mid-month read, which was up 0.2%, gets downgraded to only up 0.1%. Up 0.1% equals where we were in April. To find a higher number, you go into March when it was up 0.3. The high water mark there was January for this year, where it was up 0.8%. We look at interest rates today and we see a 4.22 in 10s. Basically, for the last 3 sessions, we closed at 4.22 on Jobs Friday, and we've been hovering in the low 4.20s. Not a lot of volatility. 30-year bond auction at 1 Eastern, $25 billion. At 11:30 Eastern, historic 4-week bill auction to the historic amount of $100 billion. Carl, back to you.
All right, Rick, talk soon. Rick Santelli. Let's get the latest on trade this morning. The president did announce 100% tariffs on chips unless companies build in the United States. A number of chip names moving higher on the exemptions part of that news. But Intel is sitting this one out after the president called for the company's CEO, Lip Bhutan, to resign, calling him, quote, highly conflicted. That comes after Republican Senator Tom Cotton questioned his ties to China. Let's bring in Megan Casella from Washington with the latest. Morning, Megan.
Hey, good morning, Carl. That's right. A lot for the chip sector to navigate this morning. But first, let's start with Intel. Here was the president's exact wording on the Intel CEO. He said, the CEO of Intel is highly conflicted and must resign immediately. There is no other solution to this problem. So some harsh words there from the president. We have not yet heard from Intel publicly commenting on this one, but as you said, it does come after Senator Tom Cotton, an Arkansas Republican, claimed that the Intel CEO controlled dozens, he says, of Chinese companies, including 8 that he says had ties to the Chinese People Liberation Army. So much more to watch there with the president pressuring this CEO. Obviously, you saw the shares, you see the shares under pressure this morning, and also coming at the same time as that other big chip story. And as you mentioned, the exemptions part of this is going to be the key here. So take a listen to exactly what the president said last night.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge, even though you're building and you're not producing yet in terms of the big numbers of jobs and all of the things that you're building. If you're building, there will be no charge.
So he went on to say that even the intent to build could possibly shield a company from these tariffs. And the list of companies intending to build in the U.S. now is really long, especially after that CHIPS Act rollout under the Biden administration last year. NVIDIA, TSMC, even ASML, Global Foundries, all of these companies have these intentions or plans to build at various degrees of being underway or not. All of them potentially then shielded from the impact of what would be a very significant tariff. Guys, one major caveat I would say to flag here is that the statute being used in question here doesn't allow for company-specific exemption. So there's not a way that the administration could easily say 100% tariffs for everybody except for example, Taiwan Semi. They can't do it that way. What they would have to do is find a way to very narrowly target specific products and maybe go chip by chip to find a way to exempt specific companies' chips themselves. So there's going to be a lot of creativity, I would say, here, and a lot of reason to watch the wording of this as we get it potentially as soon as later this month, guys.
Well, Megan, looking at the performance of Apple stock over the last 2 days, clearly there was also an expectation of a specific product being exempted, namely the iPhone. What do we know at this point in terms of that?
We don't know a whole lot, but I can tell you a little bit about expectations. So the way that this investigation into the semiconductor tariffs was written, it was really, really broad, much broader than most people expected, and it allowed for the possibility of tariffs on any products that even include semiconductors. So of course iPhones get caught up in that, as does almost every product in the technology supply chain. So they're saying that they could possibly impose tariffs on all of that, but I have been told that the administration is unlikely to at least start there, that the tariffs would be more narrowly targeted to begin with and not include those downstream or derivative products. We have seen them show some flexibility on that with sort of the steel, aluminum, copper, and auto tariffs that are in place. There are some exemptions there as well with the broader parts of the supply chain. So likely to be shielded to start with, but I would say it does maintain that level of uncertainty that they would allow for it to potentially happen in the future, even once they announce the first round of tariffs.
Absolutely. It's not done ever, or until it's done, I guess. Megan, thank you so much. Joining us now to talk about the tariff impact on the markets and more is Mira Panda, JP Morgan Asset Management Global Market Strategist. Mira, JP Morgan Global Economic Research had a really great piece yesterday where they said the sector-specific Section 232 tariffs are likely to have a much bigger impact on the effective tariff rate than country-specific tariffs, and they think it'll settle around 22%. How much do you think that is borne by the consumer, and how much of that will be taken in from margins from the companies themselves, and what does that tell you about the stock market?
In aggregate, we're expecting that around 60% of the overall cost of tariffs gets passed on to the consumer, and the companies retain about 40% of that. But certainly it will be carrying the load on both sides and have an economic impact when we think about the consumer and also profitability. But what we do get coming into next year is a bit of a tailwind for both the consumer and corporate profitability when we think about the tax cuts, because there are some sweeteners in there for consumers which should help lift consumption and help growth. There are also some sweeteners in there for corporations, providing a lot of provisions from 2017 and potentially helping profitability here. So while the cost from tariffs may increase as we go throughout the rest of the year, as you get into next year, it may actually be outweighed by some of the benefits from tax cuts for the first half of the year.
But those two things sound like they could be inflationary as well. Is that a concern of yours?
It is. I mean, when we think about what the Fed's reaction function is here, we know that the jobs report got a lot weaker more recently, and it's not just one number, it's really been the trend when we think about those revisions. But the reality is we're still in this sort of no hire, no fire, I'd add no supply market when it comes to jobs, and maybe we're in more of a standstill as opposed to a decline. But when I think about inflation, we're probably going to continue to see goods costs rise. You might see a lift, but then a shift away from areas within the services that may help inflation fall by the end of next year. But if you also see a boost to growth and inflation often move in the same direction, that may keep inflation elevated in the first half of next year.
And of course, what does that tell you about kind of the Fed and its trajectory for rate cuts if we're looking at elevated inflation next year? The market's pricing in 3 rate cuts here. Does that kind of pour cold water on that notion?
In our mind, it does, because it's not only about what happens for the rest of this year. Do you see 1 rate cut? Do you see 2? We probably wouldn't see more than 2 given that inflationary picture. But as you get into next year, if inflation's being held higher, if growth is actually accelerating, even if just for a shorter period of time, does that further push out even more rate cuts to the back half of the year? And then overall, do we see fewer cuts than the market is anticipating, not only for this year, but also for next year?
Do you get the sense that the cracks forming in the labor market are also temporary if you're expecting, growth to accelerate, inflation to accelerate? Or do you think that's just a part of a bigger complex picture?
It might be part of the bigger complex picture, but what we see in the first half of next year is that if growth is a little bit higher, potentially that extends the life of the labor market a little bit, but they're somewhat separate in that the tax cuts will very much help out consumption, but if you still have a labor market that's overall weakening, there's a question mark there. A lot of the tax cuts are going to potentially spur CapEx and investment, How does that pass through to hiring? We're not quite so sure. But ultimately, even if the Fed is not cutting as much as the markets think, I don't know how much that will actually help the labor market one way or the other. Because if you look at labor market data from last year on the JOLTS, it's basically exactly where it is today. If you look at this morning's initial claims, it still looks like there's not a lot of layoffs going on. And if you look at small business surveys, the NFIB, they rank the top 10 business problems for small businesses. Number 10 is actually interest rates and financing costs, whereas number 2 is quality of labor. So, and quality of labor is actually higher than the overall cost of labor as a business consideration. So I'm not sure how much a fluctuating rate outlook actually will help the labor market one way or the other. There are these different dynamics at play when you think about immigration, demographics, that's actually also slowing supply. It's not just that demand is also getting a little bit more anemic.
Yeah, especially if market rates stay high as well. Mira, thank you very much.
Get a look at our roadmap for the rest of the hour. After the break, the CEO of ConocoPhillips is with us. Off of earnings, the company aims to deliver $1 billion in additional cost reductions by the end of next year.
Plus, we're going to talk to CalPERS CEO Marcy Frost about President Trump's push to bring private assets to 401ks, amongst other subjects.
And Eli Lilly slimming down. We'll talk about the pullback for the stock despite a strong quarter driven by its weight loss drugs. A big show ahead. Squawk on the Street is back after this break.
And make it count.
Just over 30 minutes into the trading session, 3 big movers we're watching today. Shares of Dutch Bros spiking as the company tops estimates for the second quarter and gave pretty strong full-year guidance. Duolingo jumping as well on some solid earnings and guidance. Daily active viewers up by 40% from a year ago. But Airbnb is moving lower despite beating earnings and revenue estimates. The company did warn of some tougher travel months ahead.
When we come back, Eli Lilly wilts despite a strong quarter. We'll talk about the weight loss data that's sending those shares tumbling this morning, currently down more than 14.5%. Plus, private equity to go mainstream. We'll talk about President Trump's upcoming executive order to open up 401ks to alternative investments and much more next hour on the energy market. when we are joined by the CEO of uranium and nuclear company NextGen. Stay with us.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend
$1 billion one-time synergies, $1 billion of run rate synergies, and we're effectively delivering the same pro forma production with none of the Marathon rigs sitting in the business. And that's given us the ability then to look at the portfolio and think about some of the non-core assets that aren't competing for capital in our new scale and size in the company. And that's what really led to the $1.3 billion disposition. We promised the market about $2 billion of disposition following that integration with Marathon. We've over-delivered on that, and we're not done yet.
Explain to viewers where your production strategy is for yourselves and also for the industry, and how that ties in with the raw cost of the goods right now.
Yeah, right now we're seeing some deflationary forces a bit in the business, offset by some of the tariff impacts with steel and aluminum. But by and large, with the reduction in the rig rate, we're seeing some deflation across the U.S. side of the business, with a little bit of inflation going on globally, but it hasn't really been a significant cost of goods increase for the company. So we're running pretty well in the 60s, and look, there's some near-term choppiness in the market, but our long-term view is quite constructive given the demand growth that's occurring around the world, albeit there's a little bit of extra supply in the market with the OPEC plus decisions, but that ought to work off relatively quickly. So long term, we're very constructive.
I'm curious how you're assessing kind of the M&A picture right now, as we've seen earnings come in lower amid lower oil prices. And we heard Exxon's chief executive, Darren Woods, say that he was open to other M&A opportunities after losing that Chevron Hess bid. So kind of where do you see ConocoPhillips playing in all of that?
Yeah, I think we've been very active in this space over the last 4 years, Leslie. Look, we merged with Koch, we bought the Shell assets, and we most recently did the Marathon acquisition. So we've gotten our portfolio into a great spot. Now our focus is turned to the organic investments that we're making in the portfolio. Look, our asset quality advantage is significant against relative to our peers. Even the integrated majors were objectively, with third parties, viewed as some of the best tier one acreage in the unconventional space left, with decades of inventory. That, combined with our global portfolio today, gives us a ton of economic or organic opportunities to invest in the company. So that's where we're focused today, but that's coming on the back end of about 4 years of very active inorganic growth and mergers in the business. And I don't think that's done in our business as well as we go forward with some of the choppiness in the commodity price that I talked about earlier. But for our company, it's a focus right now on organic growth. The LNG business in the US and in Qatar, and a large project that we're developing in Alaska. That's going to lead to $7 billion of free cash flow growth over the next 4 years, which is about equivalent to the free cash flow that we're delivering today. So a doubling of that in the next 4 years. And I think those are catalysts that are unmatched in our business, even with the integrated majors.
Do you get the sense that the market is hungrier for maybe some stronger production guidance? Where would pricing need to stand for you to step on the gas? And when do you think rig count turns around? Seems like every Friday we wait for the number and it does come in a bit lower.
Yeah, I think there's a bit of choppiness at the $60, Carl. Look, I think the U.S. probably, we're like many, probably sits at a relatively plateau level at these kinds of prices. It's going to take a signal probably into the 70s. There's plenty of resource sitting in the U.S. The quality of some of that resource in some of our competitors is going down. And we're delivering modest, 2-3% production growth already. So we are growing our business off a platform that's 2.4 million barrels a day of production today. So we are growing the company. I think to see a broader signal across the U.S. flatten or start to incline the rig count probably needs more sustainable prices in the 70s relative to where they're at today.
What about LNG? We've got the EU now committing to buying at least double what they have been in terms of that. Obviously, we talk here endlessly about the need of data centers for power, much of that supplied by natural gas. I know we got plenty of it, but can we get it where it needs to go and, do it all in a pretty quick manner?
Yeah, that's one of the challenges, David. Look, the infrastructure permitting reform, we need to get it from the central part of the USA out into the coast, in the Texas, really the Gulf of America coastline. We're leading into that with a big project in Port Arthur. We expect there's going to be 10 to 15 BCF a day of incremental liquefaction capacity being built here in the U.S. that then we can export to our European and our Asian partners. And so that's coming. And as you said earlier, there's plenty of gas in the United States. The challenge is getting it from where the basins that's being produced, which is primarily in the Haynesville, the Marcellus, and the Permian. But we may see more infrastructure coming out of the Permian to handle the extra gas that's coming with the oil production. So it's pretty balanced, but you're right, in order to accommodate the AI and the electrification and the power that's going to be needed, a lot more infrastructure is going to get built. And that runs smack dab into this permitting reform. And somehow we've got to ease the pressure and speed that process up.
Yesterday, we saw additional tariffs placed on India as effectively retribution for buying Russian oil. If we start to see more actions like that, do you think American oil supply can fill that gap?
Well, I think today, again, it's going to take a price call, and that's the choppiness that we're creating in the business today with the tariffs. Is there going to be sanctions on Iran? Is there going to be further strengthening sanctions on Russia? OPEC Plus is recognizing some of the demand growth, so they're bringing some of that spare supply into the business. So I think there's choppiness. Inventories that are a 5-year low here in the U.S. are starting to grow a little bit. That's why the curve is backwardated today. So there's some of that choppiness, but with sanctions and some of that other pressure and demand growth continuing, that's why I think when we get through this near term, say the end of 25 and into 26, I think the demand growth is going to kick in. Supply will be a bit challenged, so prices will have to go up to incentivize more of that supply, certainly from the U.S.
Right. Finally, on gasoline, I was just looking at some gasoline demand figures, I think, last month or two. It's been kind of the softest summer maybe since 2020, and I wonder, what do you think accounts for that? If it's sort of just macro activity or electrification of the vehicle fleet, something else?
I think it's just kind of activity, Carl. I mean, as you look at it, refineries the utilization is quite high right now on the refining side. And I think it's an equation. You got to look at both the gasoline and the diesel side of that equation. But yeah, it's been a little bit slower vehicle miles traveled as we've gone through the summer months, but we don't expect that to be a significant long-term trend. Certainly there's electrification coming. It's increasing in places like China, slowly increasing here in the U.S., but that's just a very small piece of the overall supply-demand market on the oil side of the business.
Right. Ryan, so many cross currents going through the industry. Thanks for helping us understand a little bit better. It's good to see you.
Yeah, thank you. I appreciate your time.
Shares of Eli Lilly are now down over 14+%. That is well more than where the stock opened this morning. This follows what is being seen as disappointing data for its upcoming pill to treat obesity. Let's get to Angelica Peebles for more. Angelica, this is getting pretty serious in terms of a market cap loss now.
Yeah, David, quite a big reaction today, and that's because of the data like you talked about. So let's get into the numbers. People lost about 12% of their body weight after a little more than a year at the highest dose. Now, that's below the 15% that we see with Wegovy, and that was the benchmark that people were looking for. So now the debate is, how much do those few percentage points really matter in the real world to real patients and doctors? On the side effects, about 10% of the people on the highest dose stopped taking the pill because of any adverse events, mostly GI issues. Now, that's a bit higher than what we've seen with other GLP-1s, but it's not that much different. But more surprisingly, 1/4 of patients at the highest dose stopped taking the drug for any reason. And the question is why? Were people just not losing as much weight as they wanted? What happening? And we won't know until next month when Lilly presents the full results at a medical meeting. For now, though, Lilly shares are down double digits on these results. But this morning, Lilly CEO Dave Risks on Squawk Box told us that the company is actually happy with these results.
The goal was to create an oral pill that was convenient and can be made at huge scale, really for the mass market, and had weight loss that was competitive with other single-acting GLP-1s. And that's what we've achieved. Remember, the first study in diabetes, probably the weight loss is a little higher than people expected. Here, maybe it's 1 or 2 points below what Street had, but it's right in thesis for us.
Now, Lilly also reporting earnings today, and they raised their full-year sales and adjusted profit forecast for the year after reporting better than expected second quarter results, mostly because of sales of those GLP-1s, Mounjaro and Zepbound. But that positive news, of course, getting overshadowed this morning by that pill data, guys.
So do you think, Angelica, it's the side effects that cause people to stop taking it? And is it that element that has the street worried, or is it just the 12% reduction that was underwhelming for investors?
I think it's a little bit of both. I think that people are disappointed with the weight loss overall. Of course, it's not as high as they wanted to see, but I do think the question about the dropouts, why are people dropping out? You had people, about 10% of people at the highest dose dropping out because of side effects, but then up to 25% dropping out for any reason. And people want to know why. Is it because they're not losing as much weight as they wanted to? What are those reasons? And I think until we know more, that's going to be a big question. And of course, the bigger risk is, okay, you get someone to start this drug, but if they can't stay on it, that's a big problem for them, right? Because you need people to stay on these drugs in order to see those sales estimates that people want to see from this pill.
Yeah, I think at this point, Angelica, it's the worst day for Lilly in about a quarter century. We'll keep our eye on the price action today. Angelica Peebles. Watching tech as well this morning, pacing for a very strong week. Apple's a big part of that, adding to yesterday's gains. B of A ups its target at 250, saying they believe there's potential for Apple to gain smartphone share following these exemptions. Also watching Amazon today, making a deal with the Trump administration this morning, announced it'll give the White House a $1 billion coupon to use AWS for the government's digital digital transformation. Check out shares of cyber name Fortinet as well, losing a quarter of its value today following weak guidance for its Q3 revenue. Morgan Stanley, Piper, and Key all downgrading that stock in reaction.
Not particularly helpful. That means the downgrades after earnings, of course. We used to talk about that years ago in Squawk Box. All right, let's get a news update now. Silvana now has that for us. Silvana.
David, good morning. The Kremlin says President Trump and Russian President Vladimir Putin will meet in the coming days. At the same time, Moscow all but dismissed Trump's proposal for a three-way summit involving him, Putin, and Ukrainian President Volodymyr Zelensky. Now, Putin suggested the meeting could potentially take place in the United Arab Emirates, and it comes before Trump's Friday deadline for Russia to strike a peace deal with Ukraine or face tough new economic sanctions. Meanwhile, President Trump said today he ordered the Commerce Department to conduct a new census that excludes people living in the U.S. illegally. Now, it's not clear if he was referring to the scheduled 2030 census count or is calling for an earlier tally. And a new report from the CDC finds most Americans get more than half of their calories from ultra-processed foods. So for adults, these foods, which are made with ingredients you wouldn't typically find in a home kitchen, make up 55% of the total calories consumed by Americans age 1 and older. And the top sources include burgers, sandwiches, sweet baked goods, savory snacks, pizza, and sweetened drinks, guys. Send it back to you.
Sounds a lot like the American diet. Silvana, thank you. Silvana Hanau. After the break, the president set to sign a new executive order that would bring some big changes to your 401k. Some details on new potential investment options in a minute. Plus, we'll check in with the head of CalPERS, the country's largest public pension fund, on how they're navigating this market uncertainty. As the Dow now turns negative, we're back in 3.
Now, big tailwinds here potentially in this season. They've increased their digital spending in CTV, and that is expected to have cushioned the trade desk's top-line performance for this quarter. In Q1, video advertising, which includes CTV, represented like a high 40s% share of the total business. So they are continuing to look on capitalizing to that shift from linear to programmatic CTV. And they're referring to CTV as, quote, the kingpin of the open internet. They said that on their last earnings call. So that was underscoring their strategic view of CTV being a key driver for both their revenues and their competitive edge. They also have highlighted that supply is outpacing demand in the current ad landscape, especially in CTV, so it is a buyer's market. In addition to that, there are other tailwinds here as well. International expansion will be a big focus. The Kokai platform will be a big focus. Several analysts mentioned this recently as their Kokai platform and integration is well ahead of schedule. They're saying full client adoption is expected to be completed by this year, which is far ahead of schedule, and also efforts to strengthen their go-to-market capabilities. So they have had some pretty substantial upticks in their strategic plan that seem to be being effective, and their ad spend as well. North America accounts for about 88% of their ad spend, but they are growing globally right now at a pretty good rate, a fast-growing international market. So that will be a big focus in the earnings and on the call, looking to see what that global expansion looks like for them. But of course, macro uncertainty, a potential wave here, and trade tensions could squeeze them and squeeze their budgets as well, Nicole.
Okay, thank you for that, Marley. Kevin, as I look at this chart and I look at the last two earnings report, the one back around February had this big gap down. People were taking it back. And then the next one in May, they had a gap up. So it looks like we better get ready for some volatility. Your thoughts?
Yeah, I would agree with you, especially when you're looking at the technical setup going into the earnings announcement. As you talked about this time last year, we actually saw a pretty decent trend to the upside here, where the stock was actually leveraging that 20-day moving average as an area of support. We also have a very defined channel here, pretty much for around 4 months, 5 months. But then we started seeing a little bit of a breakdown. We had some warning signs here, Nicole. We lost the 20-day moving average. We started seeing a little bit of a flag pattern. You call this a bull flag because it is in a bullish formation and it's consolidating a little bit, checking back some of these prices. But we also had the warning flag of low volume at this point in time. We had this fracturing to the downside after earnings, and it was down and trying to consolidate. Now this has the same same consolidation that we've seen for a lot of charts over the last couple of days here. We had the consolidation in the lows around April or so, and then we started seeing a little bit of a ramp up. We had a nice little gap to the upside here, tested the upper end of that gap range, leveraged that 20-day moving average as an area of support, but now we're coming to the 200-day moving average, and as you kind of talked about, we might see some fireworks going into this earnings announcement. If we are able to break above, we have this volume node sitting at around $120, that could actually be your next target area of resistance for this name. And any type of fundamental breakdown, you want to leverage that 20-day moving average. If not, once again, we have this open gap to the downside here, pretty much between $65 and $70 that you have to contend with. We also have RSI actually making higher highs. That's actually bullish at this point. And MACD, for the most part, not really telling us much when it comes to the price action. So overall, it's trying to recover. It's done a phenomenal job retracing some of those losses, but now it has a really big fight with that 200-day moving average. Let's see how that's going to resolve itself post this earnings announcement.
All right, thank you for that chart. Marley, next up we have Pinterest reporting this afternoon as well. It has been a winner over 1 year, but it's seen a lot of volatility. What are people watching for?
It certainly has seen some volatility, but it has been a winner, and the winning is expected to continue for this quarter, Nicole. EPS expected to come in up 21% year over year at 34 cents. Revenue expected to be up 14% year over year, coming in at $974.61 million. That also would mark a deceleration from its growth pace in the year-ago quarter, but still some pretty substantial growth there for Pinterest. Now, they have had remarkable user growth, and they've made a lot of enhancements in their monetization strategies that they think are going to be effective, and so do the analysts that cover this company. In the quarter, global MAUs, their monthly active users, expected to reach 571.8 million, which would be close to 10% growth year over year. For their global monthly active users for the year, they're expected to reach 608.6 million. That indicates a 10% growth there. They've also made some big changes, most of them driven by AI. They've introduced these visual search features that allow you to search instead of having to type something in with keywords. You can actually take the image itself, and AI's visual language models will populate things that look similar to what you're looking for. They also introduced auto collages that will create these beautiful Pinterest boards for you, which is a big appeal of Pinterest users. Auto collages is something that Gen Z users are very familiar with. They're available in a lot of other tools. So they're hoping to drive more of a younger demographic with that auto collage feature as well. And they also have a lot of AI-powered tools to better support their advertisers, because ad is a big component there. It's called Pinterest Trend Tools. That offers insights for the advertisers on how people are searching, how they are saving, and how they are shopping using the platform. Now, I really want to note some important things about analyst coverage here. Over the past 60 days, their earnings estimates have gotten increases, which we just generally don't see that much. And they've only had one revenue miss over the last 2 years. And also, when I was looking at the analysts who cover this company, 0 of them hold a sell rating. So 81% with a buy rating, 19% with a hold rating, Nicole.
All right. Look, I think that's good to also note what the analysts are doing too. Kevin, your thoughts here on the chart?
This is actually going to be very interesting to see how this stock actually resolves itself. Last year around this time, we saw around a 4 to 5 month consolidation period between that $28 to the downside, and to the upside you're looking at around $34 to $35. We had this nice breakout to the upside after the earnings announcement, but it was just unable to sustain a distribution level, if you will, here, Nicole, where it continued to fail. It did not even really test that 20-day moving average pretty significantly. It continued to break to the downside here. Similar pattern that we see with other charts where we have this consolidation around that March, April-ish area, and then you have this situation where the stock started to gain a little bit of traction. Buyers really stepped in here. You have the 20-day moving average acting as your area of support. We also have a defined channel. Now, this channel is actually converging on itself. It's not very aggressive, but we have to keep that in mind. You're looking at that $40.90 level as your first area of resistance. If you break out from that, Nicole, you can look at another $10 to $15 extension over the long term for this name. I'm just a little bit skeptical. You have a RSI that's seeing actually lower highs right now. Small little bearish divergence here. You are seeing that volume node also increasing in this channel, or in this kind of distribution-ish area, this consolidation area. Maybe some sellers are stepping in, and MACD is really not telling you much. For an area of support, if we do see a breakdown, you're looking at the 200-day moving average at around $31.38. Also kind of aligns with that volume profile node that we have here, the significant node, this point of control. So cautiously optimistic. It's done a lot of work here, but it seems like investors really want to get some really good fundamental data in order to make the case that the valuation should go higher, and the technicals kind of symbolize that as well.
Okay. Thank you, Kevin. Last but not least, we look at Monster Beverage. I saw UBS was talking about the momentum in the energy drinks. I mean, for example, we just saw Celsius Holdings. Celsius is up over 20%. What can we watch for when it comes to Monster Beverage, Marley?
It is interesting to get those reports on the same day, Nicole, because they thrive in the same space. But as far as Monster is concerned, they're looking for EPS of 48 cents. That would be up almost 18% year over year on revenue of $2.08 billion, which would be up about 10%. Investors are closely watching the brand's alcohol brands segment because they have reported some previous challenges there and associated operating expense increases in that segment. So that update should provide some key signals about the effectiveness of some management decisions addressing those margin pressures. But this update comes as they maintain a really strong balance sheet. They have a solid net cash position of about $1.7 billion and liquidity well above liabilities. As far as expectations for the individual segments, that alcohol brand segment that they've previously cited some issues with is expected to see a negative year-over-year change of about 8%. But strategic brands, that's supposed to be up about 14%. The Monster energy drink specific sales are expected to have risen on the year, and geographic revenue, which is going to be a big focus here because international expansion is their biggest primary driver of growth right now. Outside of the U.S., that's supposed to be coming in about $837.9 million. That would be up almost 20% from a year ago. And for the U.S. and Canada, also expecting an uptick there, about 7%. Analysts, however, have done a downward revision in the last 30 days of their expectations for EPS on this one. But as I look at where they stand, about 48% of them with a buy rating, 41% with a hold rating, and 11% with a sell rating, Nicole.
Okay, thank you for that. All right, last but not least, Kevin Green looking at the Monster chart.
Yeah, a very volatile chart over the last year here, Nicole. We actually started seeing the chart around this time last year, trading at around $43.32. It did actually make a little bit of a move to the upside, testing that 200-day moving average. We also have this kind of acute pattern that's taking place, just meaning that we are potentially going to see volatility, and that's exactly what we saw. We also have a head and shoulders pattern here. We have the left shoulder at this level here. We have the head right here, and you have that right shoulder until we actually break down to the downside. What you're also actually seeing when it comes to this name is, once again, that bottoming formation, some buyers really stepping in, breaking above that 200-day moving average back in February, coming back, retesting, and it's been in an uptrend ever since. Once again, we call this a little bit of a bull flag pattern. It's a bullish trade, or bullish trend with a little bit of a consolidation. The problem that you have, though, with this one, Nicole, you are actually breaking below that bull flag channel. That's something to kind of keep your eye out on. This is a little bit of a warning sign. You're coming back, trying to retest that. The 20-day moving average is acting as an area of resistance. If you're a bull, you want to get back in that channel and really break above that. You get a little bit concerned as well. You see these volume nodes that are right here, a lot of volume that is actually taking place at these levels, and this is actually signifying a distribution, meaning that there's more sellers in the market than there are buyers. But you do have some areas of support. The first one that you're going to be looking at is around $59 or so. That has been a previous area of resistance, now kind of turning into a potential area of support. And then you also have the 200-day moving average at $56.34. Any type of real breakdown in this market or major breakdown when it comes to the stock here, once again, you're looking at that value area of around $44. The other risk signal that you're looking at is the RSI making lower highs and actually making lower lows. This is the start of a bearish divergence between this level right here, between the start of March and pretty much, let's say, the middle of May, where price was going up, but the price action itself, or the momentum, was actually slowing. MACD is in a bullish formation. It's still below the zero line, though, but a 12 EMA is above the 26 EMA. Cautiously optimistic for this one, Nicole. It does look a little bit heavy here, though. It does look like it does want to try to pull back and maybe retest some of these critical areas of support, like the 200-day moving average, before trying to move higher.
Yeah, as you showed us, some bearish signals too. Okay, great to see you both. Thank you both so much for Chart Masters today, Marley Caden and Kevin Green. Really appreciate it. Good luck there at those names. All right, after a quick break, our market meetup panel is standing by. We're going to look at everything that people are talking about on Wall Street. We'll be right back.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.